Good afternoon, ladies and gentlemen. It's a great pleasure to discuss this very interesting topic with you this afternoon, all eyes on emerging markets. And I'd just quickly like to ask if our panelists could introduce themselves. Firstly, Joseph Zeng, could you tell us what you're doing, please, at Arcadia?
Thank you, David. My name is Joseph. I was trained and grew up in the mainland China until I went to LSE to study. So it's good to come back to London. And Professor Goodhart was my professor at LSE. And I worked for the Chinese Central Bank before I came to LSE. And then I worked for a Chinese bank, and I worked for JP Morgan, and I worked for one of the largest Chinese hedge fund manager called Greenwood until the end of last year when I left to start my own fund called Arcadia Fund, focusing on PIPE strategy, private investment in public equities, focusing on Greater China equities as well as Asian equities.
Thank you, Joseph.
Thank you.
Thank you. Dr. Douglas Greenig. Doug, you're CEO of Florin CourtCapital, asset manager based in London and Abu Dhabi.
Well, hello, everyone. I'm Doug Greenig, and I'm the CEO, founder of Florin CourtCapital. We are a systematic, quantitative asset manager, and a huge part of what we do is focused on emerging markets. We trade 450 markets around the world, around the clock. And among the most interesting and compelling opportunities are the ones we find in places like China and South America, Eastern Europe. A huge focus on those markets. And so I'm looking forward to the discussion.
Thank you very much. Gary Dugan. Gary, we know each other very well. You're SEO and CIO of Dalma Capital. Great experience in emerging markets. Could you tell us a little bit about your interest in this?
Just over 4 decades in investment. But in 2009, after I just coped as a CIO with the global financial crisis at Merrill Lynch, I thought I'd go to the developing world, and I went to the frontier world of Dubai at the time to run wealth management businesses in the UAE. And of course, I hit a financial crisis to follow a financial crisis. But my wife is Indian, and I've traveled extensively in India with many, many experiences and seen dramatic change there. And in the 1990s, I traveled to China for the first time and could not believe, as we went down the gorgeous dams and saw that something of that scale was only contributing about 8% of the additional energy production in the coming years. And you're saying, wow, there's something going on here. And there's still a wow factor, I think, in the emerging markets.
Thank you. And last but very much not least, S. Sriniwasan. Srini, you're based in India and a managing director at Kotak Investment Advisors.
Yeah. Thank you. Kotak Mahindra Bank is the parent organization that I represent. The subsidiary is Kotak Investment Advisors, which is the asset management company for alternative assets. Since all of us are from Europe, let me just put some size in context here. Kotak Mahindra Bank is a $50 billion bank based out of India. It's a little bigger than Lloyds Bank or Deutsche Bank, just to put in context. And we manage about $8.5 billion of alternative assets. That's the business that I run. The public market business is a separate asset management company. We manage another $50 billion. All of this capital is invested in India. In terms of alternative assets that I manage, we invest across asset classes: real estate, private credit, special situations, data centers, and private equity.
Thank you very much. And, I thought it would be useful, first of all, to look at this asset class as a whole and compare it in this very challenging world that we're in with developed markets, and then drill down to some of the tailwinds and headwinds, and most importantly, look at some specific opportunities. The phrase emerging markets is usually taken to include all those countries in the MSCI Emerging Market Index, which includes China and India and Greece and Chile. So, Joseph, could I first ask you the big question to get our discussion going? Is it possible to generalize within this very large group of disparate countries?
For emerging markets, right? Well, I think it's very large and fragmented. I've been focused on Greater China equities and recently expanded to Southeast Asian equities. For me, the emerging Asian equities deliver the at least strongest growth profile for the next few years. And also in terms of valuation, most markets like China and Japan, which is developed market, and Indonesia still offer a compelling valuation, particularly compared with the US. I think you know this better than I do, but US equity markets, in terms of price to book, the valuation is actually quite stretched. So for me, I do foresee bigger opportunities with Chinese equity markets compared with developed markets. For other emerging markets, I think I need to borrow the brain from fellow panelists on other emerging markets.
Thank you. Gary, could I turn to you? I think traditionally two of the potential advantages have been cited firstly as growth and rapidly growing new economies, and secondly diversification in terms of a larger portfolio. If you had a position in emerging markets, this would add to the portfolio diversification. So growth and diversification, do you see those as the great opportunities, or would you like to expand on that?
Well, I totally believe in the growth story, and of course there's very, very clear evidence of it over the previous decades. I mean, I just worked some numbers out, and back beginning of 1999 to date, India's up 790%, China 335%, and the US up 321%. Emerging markets comes through a working average of 400. But often people will look at emerging markets saying, very often the dialogue is it's been a disappointing asset class. And it really depends on that period when you got involved. Right. And I think, so there's a lot of misconception. I do think if you look at the comparisons with the economic conditions that we've had over recent years, this wave upon wave of liquidity has had some positive impacts in the emerging countries, but obviously a large part of it went into the developed world. So no one's allowed this cake to be baked and things to cook properly to provide you the diversification and to give you the growth. But that's the past. I think the future is going to be very different, and I think you will get more growth and more diversification from this asset class than you've seen for the previous 2 or 3 decades.
Right. Thank you. Srini, just a general question for you also. What makes you so enthusiastic about investing in emerging markets? And before we drill down to India specifically, have you got any comments on that?
Well, emerging markets have always been subject matter of not as much of asset allocation, but as of acronyms.
Right.
There was a point in time they were called BRICS. There was a point in time they were called the Fragile Five. But I think let's put today's time period in context. And interestingly, I got a message this morning. There are 2 charts that I got. First is, it's a Bloomberg survey. Mm-hmm. It talks about the probability of recession from the highest to the lowest. I'm just going to read out the top 5 in terms of the highest possibility of recession in countries. It is UK, New Zealand, US, Germany, Italy. The least, starting from the least, 0% is India, Indonesia, Saudi Arabia, China, and Brazil. So I don't know where the fragile five is going to come from now in this context. The other chart that I got, interestingly, today was World Output Projection 2023 by the World Bank. The highest to the lowest. The highest is India, China, Indonesia, Saudi Arabia, Mexico. The lowest is coming in at UK, Germany, South Africa, France, and Italy. That should summarize where we should be investing our capital in.
That speaks for itself. Thank you. Doug, any comments on that? And I'd then like to go into the point of, can you generalize as to where the risks might be in emerging markets?
Well, I've heard some great points, and I want to expand on something Gary said, a very wise comment. This perception that emerging markets have been disappointing, and in some ways they've been a little disappointing, relates a great deal to the irresponsible conduct of monetary and fiscal policy in the developed markets for a variety of reasons over the past 15 years, but particularly during the pandemic. And that irresponsibly over-stimulatory set of policies. Those have created imbalances that are going to really weigh on growth in the developed markets, and economic performance, and even financial assets on a go-forward basis. It's interesting that if you look at the emerging markets, we haven't seen the problems during the rate hiking cycles that some people anticipated, because actually the imbalances are less severe than in the developed markets. Very, very severe imbalances in the developed market, which, by the way, will create opportunities too, but of a different kind. I think the outlook is very good for real growth in emerging markets, where you can make money from businesses that are producing real products that real people need, and not just a lot of nonsense. Also, we have the revenge in a way of the molecular economy. The choke points for global growth in the future are actually related, in many cases, to natural resources. And emerging markets play a key role in that. Whether we're talking about things like aluminium or copper or nickel or the rare earth elements and so on, these are actually going to be very, very important, and there are going to be a lot of opportunities. Which brings us to your question about risk. I think some of the risks are the ones that were discussed earlier. The discussion about geopolitical issues is very pertinent. We are headed toward a terrible and regrettable collision between the US and China. And I agree completely with Stephen Roach's comments on the subject. And the US, I'm very, very worried about the political consensus in the US that we need to stop China from succeeding. Because we're not going to stop China from succeeding. We're just going to end up in a conflict with them. And that's not good. And so that poses all sorts of interesting risks, because countries are sort of trying to figure out where they fit into all of this. More and more countries are trying to step outside of that. Macron did a little bit just recently. You see, of course, China playing a constructive role in the dialogue between Saudi and Iran. And it's going to be very interesting to see how this evolves, but that will create risks in the world. And that's one reason, actually, investors need to think about how to own the tails in the world, because this is a very complicated, unstable world, and you need to have sort of long volatility strategies where you can benefit from the divergences. That's something we focus a lot on.
Thanks very much, Doug. If we're focusing on growth and diversification, perhaps longer term, the real question then becomes, how much of my portfolio should I invest in emerging markets? Srini, would you have any comments on that?
I would go back to your first question. Would you really want to club emerging markets into one homogeneous group? I think that's a little bit of a challenge. The world, as we discussed earlier in the day, is already sort of moving away. So the integrated world is now, the geopolitics are driving it in different blocks. So to just club emerging markets into one homogeneous group is probably not the right way to do it. And certainly you need to look at the size of those markets and the nature of opportunities in those markets. And I come from the perspective of speaking about India, which is my specialization. So if you look at the size of the market, it's now the world's 5th largest economy. It has a world-class digital infrastructure, and sometimes noise can obfuscate perceptions. So it has a world-class digital infrastructure which is superior to what perhaps even the US has today or Europe has in terms of payments, settlement systems, digitization infrastructure. Digitization as a public good that has been used by the government for transferring direct benefit to the poor during the pandemic, the manner in which the pandemic was dealt with and the vaccination was rolled out. I mean, I still have my vaccination certificate as a QR code, and the last time in the United States, my daughter had a piece of paper. So, that's the level of difference that we are talking about. So you need to think about individual markets separately, not as a homogeneous group. And in that context, I would say that it's time that the asset allocators start thinking about some of these markets as separate asset allocation decisions. Right. And geopolitics will drive that further.
Well, thank you very much. I think, some other statistics might be quite interesting, that on a GDP basis, emerging markets are about 26% of the world, On a market cap basis, it's also about 26, 27. If you do a Markowitz optimization, it also works out at about 26, 27. And yet in most portfolios that have got exposure to emerging markets, it's about 8%. Joseph, would you like to comment on that? The home bias, in other words.
Yeah, I think I agree with my colleagues, panelists, that it's risky to generalize emerging market as a whole. I think it depends on where you are. I want to share with you my recent dialogue with a pension allocator. He said he feels very bad because they invest very heavily into the US equities. So he said, after the SVB event and the CS event, they feel very, very worried, so they try to diversify away from US market. But for emerging markets, if you want to generalize it, I think the biggest risk also is the currency risk, because a lot of the emerging market countries, they are vulnerable in terms of their currency because they rely a lot on export to developed market, particularly the US. Even China started feeling the pain in February because China's export to the US declined significantly in double digits to the US in February. But based on my grassroots survey with fellow Chinese entrepreneurs, I was in China yesterday. I took the overnight flight to London. I spent most of my time in mainland China, and I met with a lot of Chinese businessmen, entrepreneurs. They told me Chinese manufacturers are very, very flexible. So they adjust their supply chain. They create tailor-made solutions to their buyers, international clients. So the export of China picked up quite nicely in March. And with China fully open up after the pandemic is gone, we actually foresee China's export to the US and Europe, and particularly to the Middle East in Southeast Asia will stabilize this year. So I do not foresee the Chinese currency to have a exchange rate risk vs the US dollars. So in that sense, I want to emphasize the risk of generalized emerging market as one market. So some countries have a stronger export profile, stronger growth, and as a result, stronger currency. So that is expected to perform better than the emerging market countries' markets, which are the other way around. And also valuation is a very important consideration. As I mentioned earlier in my speech, valuation, if you look at the price to earnings as well as price to book, I think China, Vietnam, Indonesia offers attractive valuation opportunities in the market that I covered.
Gary, could I ask you the same question? You're talking on portfolio management, asset allocation, I think tomorrow. How would you see the challenge of allocating portfolio assets to the emerging market sector within a larger portfolio?
Yeah, I just think it's kind of conventional wisdom that people have been anchored on a number like 8 to 10%. I don't, even whatever the optimizer throws out, it just reverts back to 8 to 10%, as if they don't want to believe that it should be higher than that. The second point, where I think I'm agreeing with some of the panelists here, that I don't see it just as emerging. I think the very sharp distinction between what you've seen in terms of performance and also the geopolitics of China, in contrast with what you've seen out of India in recent times. The other thing, of course, is demographics. And the demographic profile across many of these emerging countries is getting very different. I mean, it's very, very wide in terms of the power of the growth of your working population and the differences that you might see in productivity. So when you add all those things up, your asset allocation should be what it really should be, which is probably 15 to 20% of your equity exposure, and not the 10% number. And I would take more, increasingly, an approach by country in the emerging countries, rather than saying, I'm allocating to one fund, unless they're brilliant at it, but just one fund for emerging markets.
Right, right. Well, there's this home bias, isn't there? I mean, there's a tendency not to invest overseas that reduces it. Doug, I've found within this very disparate group that we're looking at, one quite interesting classification was to divide the countries between the commodity bloc, the manufacturing bloc, and the semiconductor bloc. And they all have different characteristics. Would you comment on that, whether you think that's a useful sub-classification to further good analysis?
You bet it is. Yeah, absolutely. Yes, it's a great classification. I would say in some ways the commodity block, I don't know. The commodity block is in a very privileged position. Either you have the natural resources or you don't. And it's actually pretty hard to screw it up, okay? On the other hand, being in the high-tech block is a more competitive game, and it's being complicated, as we have seen, by the U.S.'s restrictions on semiconductors and other things that emerged recently. It's a very useful way. We're very involved with the commodities directly. We're quite active in trading onshore Chinese commodities, one of the most liquid markets in the world. These are huge exchanges, larger than Chicago, okay? And there are many, many interesting things happening there. In the short run, we've been seeing some cyclical factors weighing on commodity prices. In the longer run, I think I'm quite bullish on commodities, but we'll let the price action kind of dictate our positions. But I think people really don't appreciate how short we are of commodities in terms of long-run growth. The emerging markets in the globe generally is growing very rapidly, and we have not invested enough in resource extraction and the processing of raw materials. And it's not something you can turn around overnight. You know, some of the people who are great experts in this matter point out that, you know, it takes you 10 or 20 years to organize a copper mine. Things go slowly. The molecular economy is not like the digital economy. And that's why I was referring to a choke point. And that's really going to benefit those countries that have lots of natural resources.
Thank you, thank you. I wondered if we could just drill down a little bit onto some specific opportunities. And Joseph, I'd like to ask you, you've touched on some of these aspects before, but how would you characterize the Chinese equity markets? We've had great value from Stephen Roach's comments. We've talked about China already at the conference. We're seeing a rapid recovery from COVID, but we've got some quite interesting things materializing in terms of the attitude of the government to particularly tech companies, some possible roadblocks. We've got the situation with the US. How would you characterize overall investment in China?
I think from a top-down perspective, China has a lot of issues, as you have seen. As David correctly pointed out, for example, some of the Chinese policies against like internet sector, some e-commerce sector has been very negative for their stock price, and also certain government policies during the COVID period has been very excessive, unnecessary, and also the government has been very against certain imported technologies, so they want to do something called import replacement. But this provides opportunities for homegrown technologies, particularly on the hard technology side. For example, in terms of chips, semiconductors, the embargo of US government on certain advanced chips made by, for example, NVIDIA, actually create a huge demand for domestic homemade chips. They're not as good as the chips made by NVIDIA, no doubt about it. But the gap between Chinese-made chips and the US-made chips, the gap has been narrowing. It was like this, but now it's like this. Maybe in 10 years, it's like this. Eventually, maybe it's like this, So Chinese companies are working very, very hard toward this import replacement strategy. So we have seen a lot of investment opportunities in these areas, not particularly in chips, because chips is also, the business technology is very risky. The more advanced is the technology, the more risky is the technology. So our investment focus is on technology that is not that sophisticated, not that advanced, but more commonly used by the public. For example, we invest into medical instruments. The market is huge. And previously, a lot of the US make medical instruments are widely imported into China. But now, as some fellow panelists may know, Chinese are working very hard to make their our own medical device. During the COVID period, the homemade breath machine, I don't know the medical English name for the specific machine, but it's for breath, for the man-made lung, all these machines are homegrown, and it has been working very well. This is just one example. Other examples for our investment themes is consumption. Even China eventually, there is a geopolitical event. Let's say there is a war with the US. Nobody wants the war to happen, right? But what if it happens? Even it's the case, we still believe there are investment opportunities in domestic consumption, like, for example, supply chain of foods. Because even during a war, the food supply is very, very important, right? It was tested during the COVID, the lockdown period, when China experienced a lockdown last year. So supply chain of food, of prepared foods is very important. So we have been looking at some niche plays in this industry, preparing foods and distribute it around the country, make sure there is no disruption, and the logistic business related to this. They're a huge business, but they're not known, so valuation is not stretched. So these are the niche themes of investment for us. And also there is a very, very big theme. It's clean energy. China is very focused on, it's called the neutralization of carbon. There is a target for China by year 2060. China wants to achieve the neutralization of the emission and of the carbon. So to achieve that, China has been investing very heavily in clean tech. So we have seen a lot of opportunities in this direction. We're not that positive about upstreams. So I may have a different opinion with you. Not in all the commodities. In certain commodities, we are positive, but in others, we have seen overcapacity. But broadly, clean energy is a very, very big sector. So we look at some service providers in this big industry, such as software makers, such as some component makers in this play. So these are examples of our investment themes in China investments.
Right. I'd like to, in a few minutes, ask you a few more questions, actually. But could we turn to India? I mean, what are the main characteristics that you would feel would lead someone to invest in Indian equities right now? You've touched on some of these points before. But
I was quite intrigued by the conversation that happened in the panels in the morning. One was there was a comment about demographics, and one of my co-panelists touched upon that. Just wanted to give you some perspective of that. I think the earlier panel talked about the demographics shifting to much older people and taking care and so on and so forth. On a population of 1.4 billion people, if you look at the GDP per capita, it's $2,000 in India. But if you take out the 25 million people who are on the top, the GDP per capita drops down to $700. That 25 million people are the people to whom many of the digital economic copycat business models are catering to in India. The copycat of Amazon called Flipkart and so on. But it's important to understand that 25 million people is in terms of the kind of expectations, the wealth that they have, they're almost like the 51st state of the United States of America. The next 100 million are the aspiring middle class, which is where the big boom is, and where they are the big consumers in the country. And if you take the next 100 million, we still accounted only for 250 million, remember. And all of these 250 million are English-speaking, educated, aspiring, hardworking, less than 30-year-old people. And if you look at population growth going forward, India in the next 10 years will add 3 United States in terms of population. So that's where you're going to get the manpower to take care of the aging world. Now, the manpower could be able to service it through services that you can offer remotely, whether it is remote consulting. I think somebody was talking about healthcare consulting, or whether it is other forms of services. Today, if you look at the opportunities in India, India started off as, very famously people will remember, as in the software export services or as the call center capital of the world. It's no longer the call center capital of the world. If you look at some of the companies that are being built out in the software as a service business model, these young engineers who have chosen now not to go back to the United States, and we had a big brain drain 10 years ago, it's reversed 10 years ago. They're building products, and they are building products for the world from India. And the kind of ambition that they have is that those SaaS companies will, in the next 10 years, our bet will be, branded world-class products coming out of India. That's on the services side. On the consumption side, I talked about the demographic numbers, the manufacturing and the consumption, the businesses that essentially feed on consumption are a huge growth opportunity. And investors can play that in multiple ways. They can play that through investing in the public markets or in the private markets. And in the public markets, I'm not sure how many people are aware, it's one of the most sophisticated equity markets in the world. Digital, electronic has been so for the last 16 years. And despite 9/11, 26/11 in India when the Taj was attacked and so on, the market has never been shut because of any other reason. Whereas in other parts of the world, we have seen the markets being shut when there is a global event. So the market runs, and it runs with efficiency and governance. And there were 2 other points that struck me. I think earlier in the day, in some of the panels, people were talking about, real estate being a negative asset class for most people in Europe, whether you look at retail or office. It's the exact opposite in India. Retail is actually a positive asset class. As we speak, Blackstone has just filed a public offering for a retail portfolio, which they will take it into the REIT market in India. Office market is an exact opposite of what you see in the rest of the world. Today, people are worried about leverage in office markets in Europe and the US. In India, the office markets are, the bulk of the office market, it's about 150 million square feet of office space. 90% of it is for offshoring industry. It's the guys who are working in IBM, Accenture, and IBM and Accenture, by the way, had the world's largest headcount in India. And those guys are actually working in the offices. Occupancy levels are close to 70 to 80%. People are not working from home. People can't work from home. Because if you work from home, normally the homes tend to be small, there isn't enough space, there's kids running around screaming, so people prefer to come to the office and work. So in many cases, in many asset classes that you can think of, it is a complete hedge against what you see in other parts of the world.
Right.
And the last thing I want to touch upon is that, as I mentioned earlier, the digital infrastructure that India has is phenomenal. And the data center business, which so far has been the domain, most of Indian data is stored in Singapore or other places. The government made it mandatory that Indian data must be stored in India. Data center capacity will grow from the present about 800 megawatts of capacity to at least 8 gigawatts in the next 5 years. All of that is going to require a very significant amount of capital. And we believe that the kind of and the nature of opportunity, whether it is in hard assets or in public markets play on consumption, there is no better opportunity in the world today than India is.
Thank you very much. I believe the projection is India is going to be the 3rd largest economy in the world within 10 years. US, China, India.
That's right.
Gary, we're both based in Dubai. We saw in 2019 the Ramco flotation that raised $20 billion. We've seen a mass of IPOs since then. How would you characterize and rate the GCC equity markets in terms of attraction for an investor that wants to invest overseas, and particularly emerging markets?
Yeah, I think at the leadership level, there's always been a determination to change the world and to become the center of the universe. There's an academic paper put together by the London School of Economics some years ago, which puts Abu Dhabi at the center of the global economy. And they really do aspire to it. But it was only in recent years that we've actually seen them use money more efficiently and effectively to affect this. And I think just from comments on commodities we've just talked about, I don't think anyone sees a collapse in the oil price along the lines of what we've seen in the past. This is a market that is genuine shortages, massive underinvestment, and therefore I think the region can benefit from this continued strong cash flow from that source. So taken in as a package, they have the money, they're effective in using it, and they're now, as we see, showing you the scale of what they've been developing over the last 10 years, because the IPOs you see are truly global businesses, global leadership businesses, and very big. So that market is growing exponentially in terms of its scale. It won't be on a China or India scale, but everyone knows if you go to Dubai, Abu Dhabi, this is a developed country in many regards. It's an underdeveloped financial sector, and it is going to get bigger, and it will be on your radar screen.
Doug, I'm sure you have some points on that. You've got an office in Abu Dhabi. Hedge fund managers are pouring in, setting up in Dubai and Abu Dhabi. What's your comments on that?
Oh, I mean, I couldn't agree with the comments more. I mean, all the panelists up here with me made great points. I wish we could have some more disagreements for your amusement. It's amazing in the UAE. Come out and visit us. We also have a big office here in London as well. But I think that you want stable governance, you want low taxes, you want a government that is working on your side to help you succeed and doesn't just see you as a way to get money, okay? And I very much feel that the UAE, the government has my back and wants to help us succeed, and they're attracting all sorts of great businesses and lots of great talent out there. And it's a wonderful time zone in addition to our terrific office here in London. And so, I'm very optimistic. And, the thing to keep in mind is when we're talking about emerging markets, whatever the issues there, you have to consider the issues that we have in developed markets. I just got out of a very interesting discussion upstairs, a little roundtable on economics. And the outlook for the developed economies over the next decade or two is very, very tough. It's very, very tough. The balance sheets don't look good. Pete Peterson has been talking about this stuff forever. The entitlements, the deficits, the huge public debt, this sort of devil's triangle of political dysfunction, populism, polarization, and public debt. Okay? That's what we have on the developed market side. Now, I think things will be okay. But in the emerging markets, you have that real organic growth. People coming out of poverty and buying things. It's inspiring what's going on in India and in China. And then Africa is going to be next in due course. I mean, it's a tricky place, but it's going to be next. So, I think you want to have your eyes on emerging markets. That's my opinion, my 2 cents.
Well, thank you very much, Doug. We've actually run out of time, but I don't know if there would be any, perhaps you could take one question, if anyone has a question.
Middle of the room.
Okay, well, that's terrific. Thank you. Thank you. Oh, we got a question. Great. I'm looking straight into the light here. Yep, good. Thank you.
Hi. I just wanted to I just had a question. By the way, Srini, I'm from India, so you're not an exception. Just on this allocation part that we spoke about earlier, when 26% of balance sheets and market cap of the entire emerging market put together under one go is such a high allocation, we spoke about the capital allocated is much lower. My question was on the returns, and the returns was because in most emerging markets, and in India we have seen as well, is that when you dollarize the return because of the currency itself, it sometimes doesn't make that much of a sense for an overseas investor, especially from US or Europe, just because of the hedge cost as well as the cost of conversion from a return from a dollar return to a local currency return. How do we, and plus the liquidity as well. I mean, you invest in a fund in India or in China or in other economies as well in the emerging markets. That returns starts to make, because of this leakage, starts to make a little bit less sense. What's your comment on that? Anybody can take that question.
Who would like to take that question for me?
Yeah.
Thank you.
No, it's a fair question. I think if you go through the history of currency depreciation, I'm referring more to India, it's about on average about 3 to 3.5% per annum. But that is a very different era that we are looking at. I think two things have changed in the world. Number one, if you look at what's happening in the world today in terms of regional blocks being developed, already you're seeing regional blocks starting to trade in different currencies. So the dollar domination is a question mark. In fact, in the morning when somebody wanted to ask the question on, I wanted to ask the question to Larry Summers and that panel, whether long dollar or short dollar. But it's an important question to ponder. Is that the way the world is going to go through going forward? Or are we now going to go into a multipolar world? Just to give you an example, Bretton Woods conference had to have currencies backing the gold that they have. I'm pretty sure the US doesn't have the gold for the dollars that they printed. But I can tell you one thing. India has more gold than the currency it has printed. Not just in the vault of the Reserve Bank of India, but in the personal vaults of all the women in India who wear the jewelry. India is the largest owner of gold in the world. So it's a very different world you're going to deal with in the next decade. So think about it that way.
Well, thank you very much. Unfortunately, I think we've got to finish. But look, that was a great discussion. Thank you very much. And big hand for our panel, please.